I am I really dreams. Yeah.
Hello, everyone. Good afternoon. I believe that you can hear me from where you are. You are welcome to our monthly webinar in Dr. Steven Asset Management again. And I want to please with us that bear with us for the next 2-3 minutes now. So let us give them like 2-3 minutes. Thank everybody. Bless. Once again, good afternoon. My name is Olayemi David. I'm the head of IT of Dr. Steven Asset Management and the Operation. This afternoon, I have with me a seasoned investment analyst, the person of Mr. Idika Aja, and from his pool of experience. Is going going to be at sir. Good afternoon, sir.
Hello, good
Can you
afternoon.
hear me, sir?
Yeah, I can. Can you hear me?
Okay.
Hello?
Thank you very much. Okay.
Yeah, can you hear
Okay.
me?
Yes, I can hear you, sir. I can hear you,
Okay,
sir.
it's all right. I can hear you too.
Okay. Okay. I also have with me the head of our research, Mario Abolujoko. He will also be with us in this webinar this afternoon. Like I said, I will be talking on Asam e-trade and some improvements that we have gotten from Asam e-trade. But Mr. Idika will be putting us through on the roadmap to financial freedom and how you can trade your investment to a financial freedom. So that's why he will be taking us this afternoon. So I would like to bring him on board by sharing his screen. He will be talking to us for the next 20-25 minutes. And if you have any question to ask him, you can send in on our question. And I also want you to know that this program, this webinar is being live streamed on our YouTube. So I can see that some people are already on the YouTube watching this program now. So if you are having difficulties using your Zoom, you can get the link from our research department and go straight to your YouTube and watch this webinar. Thank you, Mr. Edika. Thank you. You're welcome. While I share your screen.
Okay, so I can start now.
Yes, sir.
Hello?
Yes, sir.
Okay. Yeah, good afternoon, everyone. Yes, thank you, Asam, for having me on board. Yes, before we start, I'll be talking about basically on stock and what you have to do to know the type of stock to buy. But before I do that, first of all, let us look at what actually is investment. You know, we've been talking about investment. What is investment? I think that you get that on slide 3. Investment is basically what you do to make your savings increase over time. Basically, because the naira you have today is more than naira tomorrow. So anything you do to have that your savings increase over time is what we call investment. And for that to qualify as an investment, it must meet 3 conditions. One is the time value of money. The second one is the expected rate of inflation. The third one is money. It demonstrates that it is better to have money today than in future. So when you give up immediate possession, you at least definitely you expect to have a higher amount in future. And that rate of exchange between future consumption and current consumption is what is known as the pure interest rate. For example, if you exchange certain income, let's say 2,000 naira, and we expect to have 2,080 naira 1 year from today, then the pure rate of interest or on a risk-free investment, that is what we call the time value of money is 4%. And if you divide the 2,080 naira by 2,000 minus 1, that will not give you the 4%. That will give you 4%. This is what we call the risk-free rate investment. That means whatever happens, you must satisfy this one. This is the time value of money. Definitely, you must satisfy this condition because that 4% is what we call the risk-free investment. Assuming you invest in maybe treasury bill or federal government bond, we actually know we understand what we mean by something is risk-free. For instance, treasury bill, that means government is issuing it, because government definitely will pay back. So there is no much risk. So we call it a risk-free investment because at the end of the whole thing, government will surely pay because they have the custody of currencies and they have the investment, and definitely they will pay. That is the first condition. Now, the second one is what we call the expected rate of inflation. We know that inflation normally now the inflation is going up because of interest rates. We'll see that the federal government, central banks of various countries are raising interest rates to curb inflation. Definitely for your investment to be called an investment, it must first of all at least take into consideration the expected rate of inflation. Now, assuming the price level change, say 2%, you know, we have the first one will have 4%. Now, assuming that the price level will change by 2%, that means the rate, the expected rate return has to be increased to 6%. That means you add that 2% to that 4%, you have 6%, which is the nominal, to account for that nominal rate for that inflation. That means, in our example, that means what we will now require, the investor will require, instead of 2,080 naira, the investor will require 2,120 naira to accommodate that price level changes. That is the second one. Then the third one is uncertainty on payments. You know, normally, like I said, there are risk-free investments, especially from the federal government, either treasury bill or savings bonds. Those are risk-free investments. If you invest in it, definitely you get your money back. But at times, you can invest in other asset classes that are not from federal government. That means there is uncertainty. The uncertainty is there that you might not get your money, or they are what we call both upside and downside risk, or what we call a beta. So you have to account for that uncertainty. And definitely there's going to be a premium. So that certainty of payment is investment risk. And you have to give additional return to that nominal risk and the risk-free rate. So in our previous example, our investor will demand more than 2,120 naira 1 year from now. Remember, we said the first one, that is for time value of money, the risk rate is 2,018 naira. Then if you factor in the inflation price change, you have 2,120 naira. Now, when you bring in the uncertainty of receiving the payment, of losing the investment, then you have to require 2,200 naira. Is 2,200 naira. If you look at the money you actually invested, that will give you about 10%. So for this particular investment, that means you must demand for 10%. Anything that is giving you less than that 10% is not actually a good investment. That is exactly what I'm trying to explain. It's not actually a good investment, because it will be better to go and invest in a treasury bill that can give you 4%. That one you can just get it without even factoring the inflation rate. But if you actually want to invest to cover for the time value of money, expected rate of inflation, and the of payment, then all these rates changes have to be factored in. So that means from the foregoing, we can now attempt to define investments. And if you look at the three conditions, so that means for anything to be called an investment is a commitment of naira for a period of time in order to derive future payment that will compensate the investor for: 1, time value of money; 2, the expected rate of inflation; and 3, the uncertainty of the payment. That means the likelihood that you might not get the payment. That is actually what is investment. Hello? Hello?
Hear you, sir.
Hello?
Can you hear me?
Okay, fine.
Yes, sir.
Having done that, let us go to, you can go to slide 2, because I've actually defined what investment is all about. Now we look at the equity market. Now that is where I'm going to focus on. Now the equity market is expected to face significant challenges based on rising rates. You know, rates are rising. CBN and other apex banks of various countries are increasing rates, like I said, to control inflation. And you know, during rising rates, typically the equity market is affected. period of rising inflation and rising rates. Why? Because most investors, because of the volatile nature of the equity market, most investors will prefer moving their funds outside the volatile area, because as rates increase, the fixed income investment outlets definitely will offer higher yields. So investors would like to move out of the equity markets and go to fixed income investments that can equally offer commensurate higher yields like the equity market, even though it is equally safer for them. So in a period of rising inflation and rising rates, it affects the equity market. However, investing in stocks still remain a veritable asset class that can give positive real returns. For instance, as at yesterday, June 28, 2022, the all-share index has a year-to-date return of about 20.34%, which you can easily get from fixed income investments. So it is still a veritable means of investment, and you can get a very good return from that. But the most important thing is this: for you to even invest in stock or invest in the equity market, you have to determine which stock is a better investment. Which one is better, which particular stock is better, which one should I invest? That will now take us to the actual topic for today, which is valuation. And in investing in stock, first of all, the most important thing that you need to establish the value of the stock using valuation methods. And there are various valuation methods you can use. They have discounted model, other dividend discounted, or cash flow, or free cash flow. But for today, we are going to focus on what we call relative valuation using a price-earning ratio. So price-earning ratio, I've explained investments, and I've price-earning ratio. Normally, you can easily get it from Bloomberg, get it from anyone, this financial, either Yahoo Finance or Bloomberg. You can get price-earning ratio of any stock or any company you want. But what is the meaning of price-to-earning ratio? Some people call it a PE ratio. So price-to-earning ratio is one of the most widely used metrics. Please, can you go to slide 5 so that they can follow me? Slide 5. Slide 5. Okay. Okay, fine. Thank you very much. The PE ratio is one of the most widely used metrics for investors and analysts to determine stock valuation. It is widely used, but at times it is somehow abused, because it offers different results. So you have to really understand it. And price-earning ratio is a measure of expected earnings. That means it compares the earnings of a company to the current market price of that company. And definitely, again, it derives its meaning from the payback multiple, which is the time it will take to recover one's investment. So normally, when you check, you see, for instance, First Bank may have a price-earning ratio of 3.06x. So it will take you about 3.06 years to recover your investment. You are in First Bank. That is what it means by it derives its meaning from the payback model, which is the time it will take to recover one's investment. Now, it shows what the market is willing to pay today for a stock based on its past or future earnings. Now, what this one is saying is this. Like I explained, using that First Bank, which is 3.06, assuming it is 3.06x, that's the price-earning ratio, is showing that investors are willing to pay for every earning, every naira the First Bank earns, that investors are willing to pay 3.06 naira for every 1 naira earning. That's what that one is showing. That it shows what the market is willing to pay today for stock based on its past or future earnings. Now, in price earning ratio, we have two types. We have forward price PE ratio, then we have a trailing PE ratio. For me, I prefer the trailing, which is the immediate past 12 months. Are you can hear me? Hello? Hello? Hello?
Can you, sir?
You can hear me? Okay. Please just because okay. I said it shows what the market is willing to pay today for stock based on its past or future earnings. So what it means that if First Bank has a price earning ratio of 3.06, it means that investors are willing to pay 3 naira 0.06 kobo for 1 naira of each earning. So that is the meaning. Then it helps investors determine the market value of stock as compared to other companies' earnings. Like I said, price earning ratio is a relative valuation method. That means you have to relate it with other companies, either in the same industry or the broad market. Then in addition to showing whether a company stock price is valued or undervalued. Okay, now the price earning ratio, PE ratio, can tell you whether a particular stock is overvalued or undervalued. Now, typically when you have a low price PE ratio, it could mean that the stock is undervalued. But when you have a price earning ratio relative to the same company in the same industry, it could also mean that that stock is overvalued. Now, like I said, okay, please go to slide 7. Go to slide 7. Hello? Okay, so to determine whether hello? Hello?
Hi, sir.
You can hear me?
Yes, sir.
Okay. Yeah. Then analyzing pricing ratio to determine whether a stock is valued or undervalued. Like I said, you have to compare that particular stock to other stocks in each sector or industry group. Normally, you have to do, like I said, it's a relative valuation. So if you want to know whether First Bank stock is valued relative to Zenith Bank, then you have to, if you are using the price earning ratio, you have to look at the price earning PE ratio of Zenith Bank and look at PE ratio of First Bank and see which one is lower. Typically, the one that is lower is adjudged to be undervalued relative to the one that is higher. So if First Bank has a price earning ratio of let's say 2.73x, and the Zenith Bank has 2.79x, it could mean that First Bank stock is undervalued relative to Zenith Bank. So definitely, what, like I said, it's a relative valuation method. So you have to compare with other stock. Now, in a situation where you have, like I said, where you have a rising inflation environment, normally apex banks attempts to raise interest rate to control inflation, and we know that in certain industries do well in this environment. Maybe in a situation where you have a rising inflation environment, the interest rate is high. There are some industries that do well in that type of environment. For instance, in a rising inflation, if the interest rate is high, banks definitely earn more income because as interest rises, they can charge higher interest on their credit products. So as an investor, the better option for you is to look for those stocks or those companies that can now benefit from a particular business cycle and invest in that particular stock, because in any business cycle, whether recession or depression or boom, definitely there are some companies that take advantage and benefit from that. So as an investor, what you have to do is to look for those companies in that industry that can that are likely to benefit from such a business cycle and invest in them. Then you now use these methods, the PE ratio, to find out, okay, this particular industry, which one is better? Which one should I invest in using the price earning ratio? The same thing, converting a low interest environment, bank earn less. If it is a low interest environment, maybe what will have like a expansionary monetary policy where you reduce interest rates, banks earn less, while consumers, cyclical goods usually have higher earnings because consumers may be more willing to purchase on credit when rates are very, very low. So these are the things as an investor you have to consider. Now, there is an aspect we have to look at, and that is stock trading on a higher price to earning ratio a good stock or not? Like I said before, you have a low PE ratio, you have a high PE ratio. Some stock trade on a higher PE ratio than others, which is normal. And where I'm asking, does it mean such stocks are better than those trading on a lower PE, or that the stock is overvalued? Typically, a high PE could mean that the stock price is high relative to earnings and possibly overvalued. Conversely, a low PE might indicate that the current stock price is low relative to earnings. But actually, to arrive at a conclusion, like I said, the earnings multiple has to be referenced to a particular company or the industry to actually know whether it is a good stock or not. So it is very, very important because, like I said, it is a relative valuation. So you have to make comparison. Now, like I said, price earning ratio of firms varies across time, market, industries, and companies due to fundamentals. We always advise it's better, apart from the ratio, that whatever stock you want to invest in, it's better. It's very, very important that you look at the company's fundamentals. It's very, very important. Look at the company fundamentals, then look at do technical analysis to actually find out. But apart from considering those fundamentals, you have to compare your PE ratio to market against its historical average to determine if the market is over or undervalued. For instance, the average year-to-date price PE ratio of Dangote, taking yesterday's date, is 13.06. That is, it means that Dangote is trading 13.06 times the earning. And Dangote has a year-to-date return of +7. So from January to date as of yesterday, so Dangote has gained 7% and has a 1-year return of positive 24.5%. Now, you look at Zenith Bank. Zenith Bank has a year-to-date PE ratio of 3.20, a year-to-date return of downside 13.7%. That means Zenith has lost 13.7% from the beginning of the year. The same thing for a period of 1 year, the stock has lost 8.82%. Now, if you look at First Bank year-to-date price earning ratio is 4.32. Year-to-date return, that means has gained 88% and 1-year return of 57.2%. Now, if you look at these three stocks, I just want to do a comparison based on what I've been saying. Assuming above factors hold and holding other factors, we can now determine which stock from these three stocks, which one is overvalued or which one is undervalued compared to the other stock. You know that Dangote Cement, Zenith Bank, and First Bank, they don't operate in the same industry. Zenith Bank and First Bank operate in the same industry. Dangote Cement operates outside the banking sector. So, but it will be wrong to assume that because Dangote has a higher price to earning ratio, that it is overvalued compared to Zenith that has a lower price ratio, and First Bank, which has a lower price PE ratio of 4.32. And that is where we come in. That is where you bring in earning yields in order to really establish which one is better. You can now you can use earning yields to determine which of them is better. And earning yields is the inverse of price to earning ratio. That means when you want to calculate price earning ratio, you just divide the market price by the earning per share. But if you want to get the earning yield, you divide the earning per share by the current market price. So earning yield is an inverse of price earning ratio. And you use that earning yield to determine actually to support your decision whether a stock that has a higher price earning ratio is better than a stock that has a lower price earning ratio. Now, looking at their respective trailing 12-month price earning ratio, now, like I said, it will be wrong to assume that Dangote Cement is a better stock because it traded at a higher PE ratio than Zenith Bank and First Bank. Though Dangote Cement does not operate in the same sector with Zenith Bank and First Bank, it may mean investors are expecting Dangote Cement to grow earnings faster in the future. Dangote has a higher price earning ratio. That doesn't mean that Dangote is overvalued. It could mean that investors are expecting Dangote Cement to grow earnings faster. That means they have much faith in Dangote and they are willing to pay more. That is why Dangote has a price per PE ratio is higher than First Bank. Now, Zenith Bank with a lower price earning ratio of 3.0 when compared to First Bank 4.3 may indicate that the stock is undervalued relative to First Bank. The bottom line is that a high PE ratio, whether versus sector, subsector, market, or its own past growth, means that investors are paying more for Naira of earnings. So whether it is undervalued, whether it is compared with similar company or sector or subsector or the market or its own past growth, it means that investors are paying more for each Naira of earning. So if you have, if Dangote has a price earning ratio of 12.95, it means that investors are paying for each 1 Naira of earning, they are paying 12 Naira 95 kobo. While for First Bank, investors are paying 2 Naira 73 kobo for each Naira in earnings, while Zenith Bank is paying 2 Naira 79 kobo. That's just the meaning of price earning ratio, whether you compare it with sector, subsector, or the market. Hello?
How is you, sir? Can I hear you?
Are you? Okay. Now, we look at the price ratio and yields. Like I said, price ratio and earning yields. Typically, it's possible because a low price PE ratio has a high earning yield. I have already explained how you can get the earning yield, which is the earning per share divided by market price per share. And if Dangote has an average year-to-date price-earning ratio of 13.06 and earning yield of 7.6%, Zenith Bank has an average yield of 3.06 and earning yield of 31.45. That has to explain that possibly if you have a low price PE ratio, definitely you have a high earning yield. As can be seen here, Dangote has average PE ratio of 13.06x, and the earning yield is 7.6%, 7.67%. Zenith Bank has 3.06 x, and earning yield is 31.45. First Bank has 4.32 and earning yield of 29.75. So earning yield explains the relationship between the earning per share and the market price per share. Now, in order to decide which stock is better or to have an optimal asset location, you can use the earning yields and compare the earning yield with the broad-based interest rates, such as the treasury bills, bond, and indexes, such as all-share index or NGS stat. Typically, if the earning yield is less than the rate, for example, if the federal, the bond yield, 10-year bond yield is 11.12%, and you see that Zenith Bank has the earning yield is 31.45%. So you can now know that Zenith Bank is a good investment because the earning yield is higher than the broad-based bond yield, 10-year bond yield, which is about 11.12%. So that means it is safer to invest in Zenith Bank because its yield is better than federal government 10-year bond yield. So you can see how you can use earning yields with price earning ratio to actually know that which stock is better industry-wise and compare it with a broad-based rate. Hello?
Sir.
Hello? Yeah, so if you look at it, that if you use this stock for illustration as a close of business, that is the last 514. Zenith Bank has a share price is 21 naira 70 kobo. Then earning per share is 7 naira 78 kobo. Then price earning ratio is 2.79. Then earning yield is 35.85%. Now Zenith Bank has a share price as at yesterday was 11 naira 40 kobo. Earning per share for 17 kobo, then price earning ratio 2 naira 73 kobo, then it has an earning yield of 36 naira 58 kobo. Now, based on these variables, you can see that First Bank has a better earning yield at 36.53% compared to Zenith Bank at 35.85% and Dangote Cement 7.72%. Now, you can now form an opinion that, okay, First Bank has a lower earning yield compared to Zenith Bank, and equally has a higher earning yield compared to Zenith Bank. So you can now say that First Bank is better than Zenith Bank. Now, if you compare the earnings yield of these stocks with a 10-year federal government bond, which was 11 naira 148%, then Zenith Bank and First Bank are undervalued compared to the reference bill. Why Dangote Cement is overvalued? Because Dangote Cement has a yield lower than the 10-year federal government yield at 11.14%. So you can now come to the conclusion that Dangote is overvalued, while Zenith Bank and First Bank are undervalued compared to 10-year federal government bond yield at 11.148%. So this is how you can use PE ratio and yields to actually determine which stock is overvalued and which stock is undervalued. Thank you very much.
Thank you very much, sir. That was a wonderful, that was a wonderful presentation, sir.
Okay.
May I know if there are any questions? Hello? Hello?
Hello.
Hello, good afternoon, sir, Mr. Festus.
Thank you very much. Let me commend
You have the floor, sir.
Yeah. Let me commend the presenter for a job well done, making us understand the issue of earning yield as a way of measuring. But my question is, I mean, since these things are not static, how often should we be looking out? First, I didn't get where he said we can get the broad-based 10-year-old bond, which is the standard to measure the investment we already have. Where can we get it? And how often should one do the review? You know, you may change today and then the scenario tomorrow actually look different. How often should we, because you can't take decisions, so for any decision you have to take has some cost implication. How often should we react to changes in this scenario? Thank you. That's my question.
Thank you very much, sir.
Okay, can I take the question, Mario?
Yes, you can. Go ahead, sir.
Okay, yes, you are right. The price earning ratio is a function of the market price and the earning per share. Normally, if you Google, you can see from Bloomberg or Yahoo Finance, you can see what normally they write EPS, or you can even Google say Wall Street Journal. You can see earning per share, and some of them they even have their price earning ratio. Now, normally you have the EPS. What normally they have a TTM, that is the trailing 12 months. I mean, that trailing 12 months means the past immediate past 12 months. And that's what we normally, like I said, I always prefer the trailing PE ratio. That means we are calculating the PE ratio with the earning per share. The share price changes, and as the share price changes, the price earning ratio changes to holding the EPS constant. So the most important thing is to have your share price and have the earning per share. If you want to calculate, just get the earning per share and get the stock price, then divide the stock price by the earning per share. You can get their price earning ratio. Normally, if you want to get your APS, it's everywhere. You can Google or even check the financial statement of the company and get the earning per share. Then divide the share price by the earning per share. That will give you the price earning ratio. It changes. The same thing with the earning yield. The earning yield, you divide to get the earning yield, you divide the earning per share by the share price to get the earning yield. As for the federal bond yield, you can Google investment.com. I mean, either you check there, you can see the federal government yield, or you go to debt management office websites or central bank, you can get the rates from those sites. So you can now do comparison and say, okay, this is the rates, the federal 10-year federal government, this is the yield, this is the rate at this particular day, then this is what the earning yield is giving me. They will be able to compare and have an opinion. So, okay, this one is good, is undervalued relative to the yield.
Thank you very much, sir. Does any other person have a question? Is there any other question? Is there any other question? Okay. There are no responses. So please, if you check the chat, I dropped some of the websites Mr. Idika referred to. So you could pick it up from there, you could pick the link up from there and check it out, sir. Check it out. So in the absence of any further questions, I would like to thank everybody for attending this webinar, and we hope to see you. We really want to thank Mr. Idika for taking out some time to be with us, to join us on this webinar. And we hope to have more of him in subsequent webinars. Thank you very much for joining. As for the presentation, it will be shared with you, it will be shared with everyone who attended this webinar, as well as the video recordings of this session. So you can always play back. You can always play back to get salient points from the presentation. Thank you very much for attending. I would like to close the webinar.